Most business owners don't lose money because of bad products. They lose money because of silent financial errors that slowly eat away their profit without making any noise. In this video, we are going to expose the 7 most common business finance errors that quietly destroy profits, and more importantly, how to fix them with practical examples. Error number 1: the blind pricing trap. Many owners price based on competitors instead of cost structure. This creates a deadly trap where the product sells well but generates zero real profit. Imagine you sell a product for $100. Your cost of goods is $60 and operating expenses per unit are $20. On paper, your profit per unit is $20. But after including merchant fees of $3, packaging of $2, and returns averaging $5 per unit, your net profit becomes negative $10. The business owner only sees the selling price and thinks margins are fine. In reality, hidden costs silently kill every sale. Proper pricing requires fully loaded cost calculation before setting prices. Error number 2: fake profit from uncontrolled overheads. Revenue looks good, invoices are paid, customers are happy, but the bank balance keeps shrinking. This is usually caused by unchecked overheads that grow faster than sales. A small service company generates $1 million annually. Their direct service cost is $400,000, with an overhead budget of $300,000. So far, profit seems $300,000. But over 12 months, they add extra software subscriptions totaling $20,000. Rent increases add $30,000, and new non-billable staff costs $70,000. Total overheads jump to $420,000. Suddenly, true profit is only $180,000, which is a 40% drop without any operational disaster. Overheads must be tracked monthly, not yearly. Error number 3: slow cash in, fast cash out syndrome. Many businesses operate on delayed receivables while paying suppliers instantly. That creates cash starvation even when the business is technically profitable. A construction subcontractor bills $200,000 per month. Clients pay in 60 days, but the company pays workers and vendors in 15 days. That means every month they are cash short by $300,000. 1 month receivables of $200,000 plus 1 month operating float of $100,000. The company is profitable but always out of cash, forcing them to use credit cards or expensive credit lines to survive. The fix is shorter receivable terms, milestone billing, or deposit-based contracts to reduce the cash gap. Error number 4: inventory profit illusion. Inventory feels like an asset, but too much inventory silently converts cash into dead stock and weakens profitability. A retail business buys inventory worth $250,000 but sells only $100,000 within 6 months. The remaining $150,000 sits in boxes. That stock may expire, go out of trend, or be forced into discount sales. Suppose after 6 months they sell the leftover stock for $110,000, losing $40,000 purely because of overbuying. Meanwhile, they also lose the opportunity to use that $150,000 for marketing, payroll, or higher turnover items. Healthy inventory turns are as important as healthy sales. Error number 5: wrong profit metric obsession. Most small businesses focus only on top-line revenue or gross margin and completely ignore net operating profit, cash conversion, and return on capital. Company A makes $2 million in revenue with a gross margin of 40%. Company B makes $1 million in revenue with a gross margin of 60%. On paper, Company A seems bigger and stronger. But after operating expenses, Company A keeps 10% net profit, $200,000, while Company B keeps 20% net profit, $200,000 on half the revenue. Both companies produce the same net profit, but Company B needs less working capital, less staff, less debt, and less risk. Focusing on the wrong metric leads to bad decisions like scaling too early. Many business owners fall into the trap of chasing big revenue instead of studying real profitability. Revenue looks powerful on paper, but it is only useful if it converts into healthy net profit. For example, Company A makes $2 million in sales with a net margin of 10%, keeping $200,000. Company B makes $1 million in sales with a net margin of 20%, also keeping $200,000, but with fewer employees, less rent, and lower risk. When you track net profit, operating margin, cash flow, and return on capital, you stop scaling blindly and start growing intelligently. Error number 6, debt without cash flow logic. Debt is not the enemy, but using debt without repayment planning is. Many owners borrow based on hope instead of math. A restaurant takes a $250,000 loan with a 5-year term at 8% interest. Monthly payment is roughly $5,000. If the restaurant's free monthly cash flow is only $3,000, then every month they create a cash deficit of $2,000. That deficit often leads to credit card usage at 20% interest or deferred vendor payments. This compounds into a downward spiral. Debt should only be taken when future cash flow can service payments, not just because sales are growing. Error number 7, no monthly financial checkups. The most damaging mistake is running the business without monthly financial review. Decisions are made by gut, not by data. A small manufacturing business goes 12 months without reviewing accounts. When they finally look, they discover vendor costs rose by 15%, merchant processing fees increased by 2%, employee overtime increased their wage bill by $50,000, and taxes were underestimated by $70,000. In total, they lost over $150,000 simply because no one monitored financial changes monthly. A 1-hour monthly finance meeting with updated metrics could have prevented most of the damage. Profit isn't destroyed by one big event. It's usually lost in small leaks that nobody notices for months or years. If you fix pricing, overhead control, cash cycles, inventory turns, debt logic, and monthly financial reviews, your business will automatically become more profitable without any big transformation. The key is not to work harder. The key is to stop the silent financial errors that kill profit. If you found this video helpful, then like, share, and subscribe this channel to get more videos. Thank you for watching this video.